All right, we're going to get started by looking at the calendar today. We just finished one of the biggest reporting weeks of the year. Uh, we had a big, about 20% of the S&P 500 report this week, including many of the big tech stocks we follow. Um, and the earnings reports were better than expected, and um, we'll go over a lot of that later on. You can see we're going into August. August has traditionally been a subpar month. Um, in the past 40 years, it's returned negative 0.15%. So we've had a really good July, and uh, right now we're overextended in the stock market. So it's not a good time to start dollar costing into positions. It's better to just hold what you have or take little profits because the next 2 months are going to be a little bit bumpy, it seems. All right, and we're going to have more volatility as we get into August, September, October. These are more volatile months. So let's go look at what else we have to look forward to. We have the next big tech stock to report is NVIDIA at the end of August. So we got to wait a whole month for that. Um, we had red on our calendar for August 1st, and that was the day that the tariff deadline, and the president basically did have a big tariff announcement, and that caused the stock market to go down. So I'm not sure if that's going to carry on into the next week or so, but we do have a combination of seasonal bad time of the year, and we have some uncertainty regarding how companies deal with these tariffs. All right, let's look at the S&P 500. Um, as you can see, I've been saying for quite a while that this 20-day extended exponential moving average has been basically a form of support for the stock market. And it wasn't until this week that we basically broke through that. Um, so that's a sign of short-term weakness. So if you're a momentum investor, it'd probably be a good time to start taking a little bit off the table because our near-term support for this um, trend that's been going on since the April lows is starting to show some weakness. And you can see that we're going from overextended down to basically halfway. So we're halfway between overbought and oversold. So there's many that say, and look at this, the volume has been increasingly higher to the negative side. And you can see when we had increasingly higher to the negative side in the past, we've had lower stock prices that come after. So for a timing perspective, it's not a good time to start buying. And if you're overextended, it's time to start taking some profits. All right, let's look at some of our meeting notes. Okay, we just had this week of earnings. For the most part, most of these stocks had pretty good earnings reports. The ones that were negative were Amazon, and we had Meta go up 12% when they reported their earnings. That was a very good report. They basically grew 24% in the quarter. Microsoft had a really good report also. They went up 3 or 4% on the news. And Altria had a good report also. And we'll go over some of these charts later on. And Waste Management also had a good report. We're going to go over in detail Waste Management later on today. All right, so let's look at the earnings reports scheduled for this week. There's not this coming week, there's not a whole lot of big stocks reporting. We have Eli Lilly, a stock we're following. The interesting thing about Eli Lilly, right now the drug stocks in general are down. They're out of favor. And the Novo Nordisk had a report that the compounding companies that were kind of illegally selling their weight loss drugs along um, because these were out of stock, they lost money because of that. So let's see if Eli Lilly has that same problem where they lose business to the compounder companies. Um, we see Walt Disney's reporting, and Berkshire Hathaway just reported their earnings, and they were, I think, subpar this Saturday. All right, so it seems like the earnings season is slowing down now. They're trickling in, and we don't have any good catalysts for the rest of the month. So a lot of times when their stock market's down a lot, not down a lot, whenever the stock market is overextended like it is now, we need something like earnings reports to help the stocks to go up. And right now, all we have is government reports, at least for the next month or two, um, minus NVIDIA in a month. All right, so let's look at some of our numbers. Um, we only have 53% of the S&P stocks above the 200-day moving average. That was 62%. So we are losing momentum in the stock market and going into some of the seasonal worst times of the year. But the good thing is the Fed is going to reduce interest rates at their next meeting, most likely. So we do still have um, basically halfway between overbought and oversold condition, technically speaking. But for the most part, almost all stocks right now are a little bit overvalued. They have challenging valuations. We've had a really big drop in interest rates this week. So that's going to affect, let's look at we'll look later on. But that drop in interest rates is going to help the home builders. It's going to help small companies that need to borrow money. It's going to help a lot of the companies that we're following that have higher yields. Because as the interest rates go down, there's going to be a bigger demand for higher yielding investments. So, and right now we're going to have some volatility in the next coming months. So as there is a flight to safety and people are getting out of the overextended stocks, we're going to have um, more people go into treasuries, which will make yields go down even more. Right. So what else do we have to say here? One of our biggest catalysts for the market to go down, tariffs. We had a huge announcement on Friday. So um, all the rest of the tariffs that were announced April 1st have been um, re-announced on Friday. So that's the companies that we made deals with, or the countries that we had deals with. So this is going to be causing ongoing problems with companies dealing with tariffs, and there's going to be a lot of uncertainty. And the stock market hates uncertainty whenever you don't know um, if there's a variable that's unpredictable that's causing an unknown in the stock market. So let's look at our seasonality again. Um, we are now in August, September, so don't expect the stock market to go up the next 2 months. And expect there to be a lot of volatility, meaning the stock market goes down um, more than 1% on a regular basis. Let's look at the charts to go along with the S&P. You can see that we have been in this uptrend to the black lines for quite a while since the April lows. And we just this week kind of broke that trend. Maybe we're going into this blue trend right here. See this right there? We're at the bottom of that channel right there. So it seems like, or we might be making a new downward channel. See these orange lines. So we're at a crossroads right now. And a lot of people that are momentum investors kind of sold out right here, and they're waiting for this uptrend to happen again. But we are still overbought, like halfway between overbought and oversold, and in the S&P. So, but we broke through the 20-day exponential moving average. That was really big. That was a huge form of support going way back, this yellow line here. So let's look at, see, the 10-year Treasury yield for this week. You can see this is a huge drop. Um, and you can see the stock market dropped with it. We had a report on Friday for a job report that showed that where the economy is kind of slowing, there's not as many jobs. There's a lot more job openings than expected. So that means the economy is slowing, and that's why the interest rates went down. Because if the employment situation gets bad, then the Fed will have to cut rates, and that makes the the yields go down. And if there is a really bad situation, and that was like a with the employment, and we have high unemployment, that means we might get into like a recession, and the stock market goes down 15% or so in a recession. So there's some fears on Friday about all that. So let's keep an eye on this 10-year yield. None of these numbers have changed a whole lot since last week. The variables of the stock market, we have price of oil going up a little bit. We have um, consistent inflation rate. The DXY has been going up a little bit, the US dollar index. Um, so it went up 1% since last week, but it's in a downtrend in general. Gold is up just a little bit this week, um, but not substantially. And let me see. You can see the dollar index continues to um, be in a downtrend, although it went up like in the last week or so, it went up a little bit. We're still in a downtrend. Okay, fear and greed index. We're neutral now. So that means we have an equal amount of fearful and greedy people, and there's no real action to take for a dollar costing perspective. When it's extreme fear, we like to start looking to buy some things or dollar cost into positions. When it's extreme greed, we try to stay away from buying in and or sell things. All right, so right now the AAII survey, we have more bulls than bears right now, and that is we have to think opposite of that. We take some caution and take some profits off the table or don't buy. Okay, fear is beginning. This is the first time in several weeks that we had the fear index, the VIX, up over 20. So it's at 20 right now. So you can see we have a sense of fear starting in the stock market, and perhaps that's we're going into some of the seasonality worst times of the month of the year. Let's look at where we're at in our emotional graph. Um, we just got out of the enthusiasm, greed, and delusional phase, and we're actually going to a denial. We have a lot of people um, that are momentum investors that are just starting to realize, no, this can't be true. Yeah, stocks can't be going down. So we're in a denial phase right now. And perhaps in a month or two, we'll have some fear. I'm not sure what the extent why would be having fear, but um, issues that may lead to a crash. We have Magnificent Seven stocks overvalued. We had most of them report their earnings, and they had good earnings, so we don't have that fear. Um, we have tariff threats. I think what they said on Yahoo Finance recently, latest tariffs pretty much set and unlikely to change. So if that's true, then I guess the outside of some commodity being tariffed. It seems like the tariff situation is pretty much set in stone right now, hopefully. Right now, we're going to find in the next couple months, we're going to have canaries in the coal mine. Tariffs are starting to bite. So we're going to have problems with companies dealing with these tariffs. They're going to start reporting issues and forecasts because of that. And that's an unknown. So we have to wait at least a month or two for all those reports to happen. And let me see what else we have. Okay. So right now, our biggest concern of is tariff threats. We'll see if that happens, have any issues. Um, P/E ratio, according to Wall Street Journal, is still around 24.81. That is overvalued by around 20%. If you look at the average, a lot of times stock markets go back to the mean. So a correction of like 20% is kind of average for us to get back to a historical average for a PE ratio, which is around 16. Okay, let's look at our first to worst. The best performing sector this year, industrials, up 14%. Utilities is second, up 13%. And then communication services, 13%. And IT is up 11%. The worst performing sectors, to consumer discretionary and healthcare. Healthcare is down, is one of the worst performing sectors for at least the last three years, which is pretty amazing to me. I just updated um, this chart. This is really interesting. The most undervalued sectors versus the most overvalued, considering the percentile rank. So if you're at a 95 percentile rank, that means you're at the highest, you're near the highest valuations of all time in 10 years. In 30 years, 85%. So you're within 15% of the highest valuation in a 30-year time frame. So it gets really risky whenever you don't have a whole lot of margin of safety investing in these sectors. And if you're investing in like an energy sector, you have a lot less. Um, they're closer to their long-term percentile, their PEs for the last 30 and 11 years. So these are the more undervalued sectors: the energy, healthcare, financials, real estate, utilities. All right, let's look at. Let's see. Okay, let's look at some of our top performers. And we always like to look at our 10-year before that. You can see the interest rate on a 10-year yield has been going down for the last couple of weeks, almost all of July. So let's look at our cheat sheet for yields of the 10-year going down. We have small cap stocks, heavily indebted stocks, high yielding stocks should do well, utilities, healthcare, consumer staples, home builders. The cost for mortgage payments go down, and that makes the housing demand go up. And unprofitable speculative companies and REITs. Any stock that yields a lot will be in high demand because the um, risk-free investment, which is a U.S. Treasury, is going down. So let's look at what's going up and down a lot, just to see if that matches our thesis. Okay, so we have oil services going down. We just had OPEC announce that they're going to be issuing a lot of oil, pumping a lot of oil. So that means so for supply and demand, the price of oil goes down. And telecom sector, that makes sense because it's a high yield sector. So if we have interest rates going down in the 10-year, anything high yielding is going to benefit. But that didn't happen this time. I'm surprised. Let's look at tech funds. Okay. Um, Let's look at the ones going up the most. Home construction. Well, we expected that because as interest rates go down, um, the price, the cost of owning a house goes down because of the mortgage rates. Home builders and gold miners. Why would gold miners go go up? I don't know. Healthcare sectors. Okay, this is a high yielding sector, and they're out of favor. Um, so as we have volatility in the next couple months, and a lot of the higher priced, higher valuation sectors go down, the sectors that are undervalued would have a tendency to go up, and the ones that are not overpriced. Let's see, consumer staples. These are high yielding. Biotech stocks. Biotech are stocks that need to borrow money and they're heavily indebted. So as they um, have lower rates for borrowing money, that would help them. And utilities are another sector that are high yielding. So the only thing that doesn't match our expectations here are the telecom, because these are usually high yielding, and you'd expect them to be uh, in higher demand when the interest rates go down. All right, so let's look at some of the market movers. Okay, so one's going up the most in the S&P. We see a lot of home builder companies here. We talked about the home builders a couple of weeks ago as a out of favor. You can't get any more out of favor than the home builders right now. But we do know the interest rates are going to start going down for the 10-year, and the Fed is going to start reducing interest rates. So this could be a bottom for that sector. Let's look at the ITB. This is the home builder, home construction ETF. Okay, so the, the holdings for this company, D.R. Horton, Lennar, Pulte Group, these are all home builders. Toll Brothers, Home Depot, Lowe's. They sell things for the home. All right, so these are all stocks right now that are currently out of favor in a major way, and it looks like they're turning. And if we look at just one of those holdings, let's look at DHI. And these aren't high growth companies. These are companies that maybe grow 5 or 10% a year, but you can see they bottomed out like right here. When I'm looking at a chart, this 20-day exponential moving average, whenever it starts turning up and a stock is just kind of baselining for a while, the longer the base, the higher in space. There's a saying, but now we're seeing this starting to hug that 20-day moving exponential moving average to the upside. So this could be a new um, sector that people could be looking into getting into right now. Let's look at the ITB. It's kind of almost parallel to the DR Horton. And some would say we're just getting started with that. And as interest rates go down and as the economy slows, these stocks will be in higher demand. Let's look at the home builder ETF going back 10 years. You can see that, we've been kind of out of favor for two years now. And that's almost corresponding to the interest rates. So let's look at the DR Horton going back a couple years. You can see that there's support right here, and there's support right here, and support right there. So we do have, but it hasn't done anything for 2 years. So let's watch that sector and these stocks. And I'll go over these stocks a little more another time. But let's look at some more of the ones going up and down. Here's Lennar, Pulte Group, and D.R. Horton are all the home builders we just talked about. Um, Extra space storage. high yielding company. They're a REIT that does storage. They're a storage company. We have, let's look at the ones doing the worst. We had a bad earnings report from Coinbase. That's like one of those stocks that are super overvalued. That's a momentum stock. We have Amazon went down 8% after a earnings report that was not accepted very well on Wall Street. And United Health, we've been following that stock too. It's like in a sector that's currently out of favor and it keeps going down. So um, it's amazing that that kind of stock, I mean, it's still going down. It went down almost 30% in the last couple months. Let's look at, all right, that's all I can get from this. Let's look at the sectors going up and down the most. Okay, we know the price of oil is going down, so that's going to drag all of the sectors around oil, energy down. Let's look at the highest one is the home construction. Okay, that's helped by the lower interest rates. We have home builders, gold miners, and healthcare. Okay, healthcare is out of favor. Perhaps it's getting started also. That's XLV. Let's look at let's look at the XLV. XLV. Okay, so you can see we're in like this consolidation pattern. This is like a basing right here, and we're at the bottom of our base for the drug stocks for the healthcare sector, and we're oversold. So this is an example of a time where I would start looking at buying something for a dividend in the health care industry. So let's look at sectors also. Let's look at the ones doing the worst. We know oil. Okay, that's all we can get for this. Let's go back to Dan Now's picks from the beginning of the year. You can see ADTN is doing pretty good. Cisco is his best pick, 13%. And KBWB, this is the big bank ETF, up 10%. Um, and IJJ, this is the mid cap ETF, and that's down a little bit, 2%. All right, so Dan has done pretty good this year with his picks. I picked out a couple charts of interest. Last week we were talking about not Philip Morris, Altria. They are, I'm sorry. Um, Altria is high dividend paying stock. They yield around 7%. They had a really good earnings report this week, and I was mentioning that as the interest rates go down, higher yielding investments are in higher demand. So not only do we have a good earnings report, we um, we have it in favor because of its high yield. Um, all right, so it's overbought right now. It's near the top of its trading range, so it's not a good time to buy that. But we'll keep an eye on it and wait for it to go be oversold. Let's look at gold. All right, so gold is actually out of favor right now. Um, you can see it's at the bottom of its trend line. The interesting thing about gold right now, um, a lot of a lot of people speculate the price of gold is a correlation to um, how much America is in debt, and a lot of times this is a hedge against inflation. So if as the United States has more and more problems with their paying their debt and servicing their debt, a lot of people might And as the stock market corrects, maybe in the next 2 months, people will be gravitating towards a safer investment that is held its value over time. So, so the chart of gold looks pretty good right now. It's at the bottom end of its range. Um, Warren Buffett, though, I have to caveat this. He said he'll never buy gold because it doesn't yield anything. It doesn't pay a dividend, and it doesn't give off any cash. So, so it's all. There's some people that say invest maybe 2 to 5% of your money in gold just as a hedge in case there's a currency crisis in the world. Okay, so let's look at Meta. I talked about this like last week or two, as we knew that they would have a good report because no, we didn't know, but Google had a really good report. They do advertising, and Meta is very close to advertising, similar to Google. And so they ended up having a really good report. And they went up like 11% or 12% that day. And they're at the top end of their trading range. So, and they're halfway between overbought and oversold right now. So, it's not a good time to buy that one. But um, that's a good idea if you of listening to earnings reports of similar companies like Google, and if they report, good earnings for advertising, then there's a good chance that Meta might also. Okay, but it's in a trade. It seems like it's in its trading range, and we're at the top end right now. So we'll wait for it to go back down to the bottom end to start buying that one. And Netflix, you can see Netflix is currently. This is a super oversold condition. You can see that almost on every facet of being oversold, it's oversold, and it's at the bottom end of its trading range. So but they had a really good earnings report. And as there's volatility in the next couple of months, um, this is one stock that's still a little bit overvalued, but they're still growing maybe 10 or 15% a year. Um, so let's watch that one. Walmart, this is an example. It's overbought right now, but we're kind of in a trading range like this. So we started right here. We're kind of like in this little trading range. Um, I would wait for it to go back down to oversold to start buying that one. But it's a very safe stock to buy with a decent yield for the yield part of your portfolio. Okay, look at this eBay. This is a stock we're following. You can see that it went up around 13 or 18% on their earnings this week. That's pretty good. And it went out of this trading range. It's not a good time to buy that one because it is overbought and it's out of its trading range. So let's wait for it to go back down to the bottom here to buy that one. Here's a news article from Fidelity. It says $4,000 gold is possible as Fed cuts, dollar drops. So I mentioned, gold has this. Let's look at gold again. Spider Gold Trust. Okay. You can see it's like a good time to buy that one, but the Fidelity gives a couple good reasons why gold is something to look at. It said it could hit $4,000. That's let's do a quick calculation on that. 3,000 divided by 4 is that's a 25% upside. It could hit 4,000 an ounce by the end of this year as the Federal Reserve cuts rates to cushion the economy. The dollar drops. Okay, so we already have a formula. If the dollar goes down, almost all commodity prices go up because everything is priced in US dollars. And central banks keep adding to holdings. So there's a demand from central banks that's pushing the price of gold up. And there's a movement away from the dollar. So that's all going to help gold, Fidelity says. So there's multi-asset fund manager Ian Sampson. He said the firm remains bullish on the precious metal with some cross-asset portfolios recently increasing holdings as price eased from an all-time high of 3,500 an ounce. Okay, so the Federal Reserve is going to be more dovish, he said, and they doubled their 5% allocation over the past year. Also, August is often a slightly weaker for markets, so more diversification makes sense. So, like I was saying, August is traditionally a weaker month um, in September. So you have this could be a safer thing to invest in whenever you have volatility. All right, let's look at waste management. So waste management, they had their quarterly results topped expectations due to a combination of higher pricing and steady demand for garbage collection. Um, the great thing about this waste management, people talk about the economy doing bad and good, but the demand for garbage collection is pretty consistent in good times and bad. So this is an example of a permanent compounder in my portfolio. I this um, because they have a monopoly, they have a near duopoly with another company. Um, they have restrictions where they people can't open new waste disposal places due to regulations. Um, they reaffirmed they reaffirmed its operating guidance midpoint. Okay, so that they gave good guidance. So they increased their price target, and we'll revisit it later. So I did the numbers on this and the estimates. They're growing at 13.1%. So they have a 3% dividend. So it's a 16% total return. And the PE ratio is 29. So the PEG ratio is around 2. So it's 2 times overvalued. But in this case, you pay more for a car that starts in the morning. Um, this would be an example of a good stock that I would buy if the stock market crashes. Because regardless of why the stock market crashes, there's still going to be a heavy demand for um, waste collection. Actually, I bought this stock back during COVID times. So right now it's overvalued, but I'm holding it because it's still growing at 13%, even though it's 2 times overvalued. Here are the pros that I saw. They have a duopoly with Republic Services. The price of commodities are going up as the dollar goes down. So that's going to help their recycling business. And they're expanding into medical waste. They bought a wet medical waste company, and it's really hard to get permits for waste disposal now. So they have a moat that it's going to be hard to penetrate. So now they have pricing power. They can raise prices, and I think this is like a permanent compounder. They can continue to grow 13% and make small acquisitions as they grow. Deregulation might allow them to acquire companies, and it's a conservative investment as we get into rocky times in the summertime. Um, okay, the bad part about it is it's overvalued. Um, let's look at the valuation measures. Okay, you can see the PEG ratio. Yahoo Finance thinks it's 3 times overvalued, and they're only growing at 10% according to their numbers. The profit margin is our base minimum, 11%, and return on equity is 3 times better than we expect, around 32%. And they have 24 billion in debt. So if we have a market cap of 992 billion, that's manageable. That's 1/4 of their market cap. So that's going to be one thing that we look at over time. Wait, where's the total debt? Total debt is 24 billion. We like to see that going down over time because um, that is one of the most um, uh, concerning things about a stock, whether they can thrive or have problems. And they have a 3.3% dividend, which is pretty good. Let's look at what Morningstar said. They said the fair value estimate for waste management is 181. So it's 20% overvalued, they said. They enjoy market share and unmatched dominance in landfill ownership, which is nearly impossible to replicate replicate given immense regulatory hurdles. So that's the moat that they have. The leadership position expanded after the firm's acquisition of Advanced Disposal, which has been the fourth largest publicly traded waste collection company. And they made a purchase for Stericycle, which gives them access to medical waste disposal business. All right, so that's the thesis. And let's look at CFRA. They said they have a buy rating. Our buy represents their defensive model and robust free cash flow, enabling consistent shareholder returns while funding growth. Pricing power and automation investments are helping to drive record margins with additional room for expansion. We're encouraged by expansion into specialized waste markets via Stericycle, offering faster growth than traditional services. Their integration track record supports confident achieving synergy target. So their acquisitions are really good over time, and they have a good track record for that. Um, so they think they're growing around 16%, but they're overvalued by 15%, they said. So that's a lot less than my calculations. You can see that their free cash flow isn't that consistent over time, and their earnings aren't that consistent, which is kind of troubling. But in general, their PE has been almost doubling in the past 10 years. So their valuation is at a higher premium now than it was 10 years ago. But the revenue is going up in a straight line, which is what I like to see. All right. So let's look at their chart. And you can see that they're halfway between overbought and oversold, and they're almost near the bottom end of their trading range. But it's very consistent zigzag pattern up. So I like to buy it whenever it's down to here around the we might get a chance to buy them lower in the summertime as all the stocks go down in the stock market. You can see that the 20-day exponential moving average, it's it's starting to hug that line in like a little uptrend. And that's the time I usually like to buy it, like right there. So, all right, let's keep an eye on that one. The stock screen I did for this week, nothing really popped out as exemplary. You can see the PEG ratio for all the stocks that are on this list. Most of them are over one, which is a good indication that we have an overbought market, like it's an overextended market. Um, so So it's an example of a time when we're pretty pricey. It's not, this is when Warren Buffett has like a ton of cash right now. He wouldn't want to buy things. He would want to wait for the fat pitch to come in. So we're like overbought right now. We're heading into two of the slower times of the year, seasonality wise. So we'll keep an eye on this screen for anything that comes up with a PEG ratio of less than one. Okay, I thought it'd be interesting to review, like maybe once a month, a review of my methodology. Um, I like to buy and hold quality forever compounders like Waste Management that grow at least 10% a year. Keep track of those stocks and their fundamentals and their thesis for long-term holds, buy and homework by analyzing the news each week and dollar cost into positions over time. So the second thing is I like to buy and hold dividend paying stocks that you can buy and hold that will give you a steady income. And use technical analysis, chart patterns to time new buys or sells. And one thing I'm adding here is sell whenever the original thesis isn't valid anymore. Um, and that could be a change in the direction of the company. Maybe a thesis has proven incorrect. Um, and that's why we follow the news every week. Okay, let's look at review what makes a good growth stock for a buy and hold. I like to buy stocks that are in an uptrend in their earnings estimates. You can see that this is an example of a stock that has consistent earnings going up. If you have a line, you can draw it and it's in a straight line up. Um, so we like to see a minimal amount of debt minus total cash, the outstanding debt. Um, we always compare that against the market cap. So if you get a heavily indebted company and they're trying to buy, they're acquiring, but they're not growing as much as they're acquiring, sometimes they go out of business. So, or they fail in financials. Let's look at the return on equity. We like to have that greater than or equal to 12. A profit margin, we like to have it greater than or equal to 12. Market cap over 50 billion because bigger companies are a little bit more reliable. And a forward PE, we like to see it low compared to the growth rate. And the growth rate, we like to see over 10. And the PEG ratio, we like to have less than 1 if possible. And okay, so this is an example. Whenever I have these stochastic charts for all these stocks that we're following every week, you can see they all follow this. Well, a lot of times they follow a trend line. And we like to buy a dollar cost in investments whenever things are the stocks are oversold, and that's like right here in the stochastics and right here in the chart. And sell whenever they're or don't buy after they reach the top of oversold in the stochastics and oversold in the chart at the top of the chart. So that's why we do this overbought, oversold talk every week. And all right, so that's a good review. Okay, JP Morgan came out with 9 stocks to short in 2025. They mentioned Tesla, Moderna, Whirlpool, Shake Shack, Mobileye, Intel, Bumble, Comerica, and Rivian. So a lot of these stocks have some of them are quality companies, but they're overvalued, and some of them are losing money and are may go out of business. So, and Whirlpool is an example of a stock is they have they're heavily indebted right now, and now they have all kind of tariff issues. Every one of these stocks have issues. I thought it'd be interesting to go over the fundamentals of what it looks like to have a bad stock. Let's look at Rivian. Look at their earnings estimates for next couple of years. Um, you can see that I guess you could say they're getting more profitable over time, but they're losing money when you have a negative in your earnings estimates. So the problem with having negative earnings is that if you run out of money, you go bankrupt. And how long would it take Rivian to be profitable is the big question. And also, would they be profitable before they run out of money? So that's an example of so they're growing at negative 16%, maybe negative 12%. Let's hope that they make a profit before they run out of money. Let's look at Tesla. Tesla example of a company, they're actually growing their earnings. Um, but if you look at their valuation, their forward P is 158. So that means they're 3 times, at least 3 times what their earnings estimates are of 42%. So this could easily drop by a third and be fairly valued. And let me see, but Yahoo Finance thinks they're 5.5 times overvalued. So that's an example of looking at stocks that um, Tesla is overvalued, but they're growing, and Rivian may go out of business. Um, let's look at, I think that's it. All right. Well, thanks for watching this, and I hope you have a really good week in investing, and I'll see you next time.